Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, financial markets have continued on their roller coaster ride this week, but we've had a couple of positive days as it relates to equity markets. So that's definitely been a positive, and that's something that we haven't seen for some time now, certainly in the month of March particularly. What's been the driver of that? And there's probably been a couple of key points from our perspective as to what's driven that. First and foremost, the significant stimulus package that was agreed to overnight in the US. It equates to roughly around about 10% of US GDP, $2 trillion in total, which we believe is certainly going to provide a base level of support to the US economy, not only to households directly, but equally to businesses. What's important, I think, around that package is that the administration certainly hasn't indicated that it'll be the only package going forward. So, we expect potentially there'll be further stimulus measures down the track. And as I said, the ability and the size of this, we think, is a real positive. Secondly, we continue to see federal bank support. So the US Federal Reserve is continuing to provide targeted support to parts of the market and certainly ensuring that the markets can continue to function. There's sufficient liquidity there, and that investors, as I said, aren't necessarily being overly concerned with, as I said, the state of the markets in the context of being able to trade. And this is certainly in areas relating to, the property market, particularly as relates to, as I said, syndicated type loans and the like. So this has been positive for our local equity market, and again, it reflects what we're seeing here domestically in regards to packages and elsewhere around the world. So we just thought it would be worthwhile then just reflecting from a portfolio standpoint, and we've just got a couple of charts today to think about. Not only when you're thinking about investing, you've got to be understanding and cognizant of what's occurring in the short term, but sometimes it is worthwhile just to take a slightly longer lens to the way that you position portfolios and the way you think about investing. And we've just got two charts here just to highlight this point. The first chart is just really a reflection of what we would say is an atypical balanced portfolio, roughly around about sort of 67% in growth assets, which are a mix of equities, property, growth alternatives as an example, and then 33% in defensive assets, again made up of fixed income, cash, and defensive alternatives. And if you looked at this portfolio over a rolling 12-month period over the last sort of 15 to 20 years or so, you can clearly see some quite varying performance in the portfolio, both in terms of its highs as well as its lows. And clearly that period of 2007 to 2009 through the GFC really highlights that point. But again, when you look through the entirety of that time period and look at the red dotted line, then you can see that the portfolio has actually generated roughly around about an 8.9% return. So for a balanced portfolio, investing in a mix of both growth and defensive assets, we believe that's actually a really solid investment return. Looking at the second chart, however, and a couple of points to note on that framework, and first and foremost, and we think probably the most important element, and this is why when we talk about investing, you're always talking about the time period that you're looking through. You can see there that the absolute number of negative periods over a rolling 3-year period reduces significantly. Yes, you're still going to have an environment like we did through the GFC, where we obviously had a number of years of negative returns. But when you compare those negative returns to the first chart, you can clearly see that the absolute level of negative performance is a lot lower. Equally, on the flip side, you don't get the same highs, but you are getting that more consistent investment return through time. And as I said, the absolute level of negative 3-year periods drops dramatically in that second chart. The other aspect to note around that chart is that when you then look through the entirety of that period, the absolute level, or the average level of performance over that period is not too dissimilar to the first chart at roughly around about 8.5%. So again, a very solid investment return. So when you're thinking about that from a portfolio standpoint, when you can actually look through the cycle, when you can balance the risks accordingly on that basis, you don't necessarily see a degradation in return, but what it actually does, it reduces the negative periods that you are experiencing from a portfolio standpoint. So when we think about the environment that we're in at the moment, the challenges that we're facing clearly in terms of financial markets, again, it's really important in our view just to have one eye on what the strategy is, what you're trying to achieve in terms of your wealth goals, ensuring that you've got that adequate balance in terms of both growth and defensive assets in a portfolio framework, because ultimately that will deliver the wealth creation that you're looking to achieve through time. As always, please feel free to reach out to your advisor. We'd like to hear from you, and we'll continue these videos and look forward to catching up again soon. Bye for now.